Then lastly, we can calculate the material yield variance. All right, and then just to save a bit of time, if you go back to the framework, you can see that the yield variance starts where the mix variance ended. So we can just carry that information forward just to save a bit of time. So this is where the mix variance ended. It's the standard price multiplied by the actual quantity in the standard mix. You can just bring that down. Then we need the standard price per kilogram. So for cookie dough, we know that the standard price per kilogram is 150 Rand, and for chocolate chips, it is 200 Rand. And we need to multiply that by the standard quantity. And please remember, guys, the standard quantity must be flexed to actual production. So it's a simple enough calculation. We want the standard quantity, and then we're going to flex that to actual production. So according to the standard, how many kilograms of cookie dough should we use to make 1 unit? In order to make 1 unit, we need 1.5 kilograms of cookie dough. And in order to make 1 unit, how many chocolate chips do we need, or how many kilograms of chocolate chips do we need? To make 1 unit, we need 1 kilogram of chocolate chips. That is the standard quantity for 1 unit. That is what they need to input into production according to the standard if they want to manufacture 1 unit. Now, the mistake that students often make is you multiply this by budgeted production, and that is incorrect. This must always be flexed to actual production. So we need to multiply this by the number of units that were actually produced during the period. Now, before we get to that, please just remember to reference always to all of your calculations. So I didn't do that above either, so let's just quickly do that over here. The actual quantity in the standard mix, that's calculation 1 and calculation 1. And the 1.5 kilograms over here was also in calculation 1, and the 1 kilogram is also in calculation 1. So just reference over here to these calculations, please. All right, and like I said, we now need to multiply this by actual production. And if you go back to the information provided in the scenario, guys, we were not given actual production. We have some of the actual results over here, but we don't have actual production. So, based on the information that you have been provided with, you need to come up with a way to calculate actual production. And what you needed to identify is you've been given the fixed overhead volume variance. And remember, we said the fixed overhead volume variance is calculated by taking the budgeted fixed overhead and deducting the absorbed fixed overhead. It's the difference between the budgeted and the absorbed fixed overhead. Now, we've got the variance. The variance has been given to us. We also have the budgeted fixed overhead. If we just go up, fixed overheads are budgeted at 24 million Rand. So we have the variance, we have the budgeted cost, which means we can work backwards in order to calculate the absorbed cost. Now, why would I want to work backwards to calculate the absorbed cost? Remember, guys, how do we normally calculate the absorbed fixed overhead? We take the allocation rate and we multiply by actual production. or to be clearer, we take the fixed overhead allocation rate and we multiply by actual production. So you can see actual production is used in the calculation of the absorbed fixed overhead. So if we can work backwards and calculate the absorbed fixed overhead, and if we can also calculate this fixed overhead allocation rate, then the missing number that we are looking for is actual production, and that's what we need. So let's have a look at this calculation. All right. Instead of writing out the formula for the fixed overhead volume variance, I'm going to just show this graphically because it makes a little bit more sense when it comes to our discussion. So we know that the fixed overhead volume variance is the difference between the budgeted fixed overhead and the absorbed fixed overhead. The difference between those two gives us the fixed overhead volume variance. We have the budgeted fixed overhead. The budgeted fixed overhead is 24 million rand. And we were also given the fixed overhead volume variance, which is 12 million rand favorable. All right. Now, please remember, guys, if this volume variance is favorable, it means that the division actually produced more than what they budgeted to produce. So actual production is greater than budgeted production. Which means, remember, how do we calculate this absorbed fixed overhead over here? The absorbed fixed overhead is calculated by taking the fixed overhead allocation rate and multiplying by actual production. The budgeted fixed overhead over here of 24 million rand is obviously not based on actual production, it's based on budgeted production. So if this variance is favorable and if actual production is greater than budgeted production, then your absorbed fixed overhead must be greater than the budgeted fixed overhead. Okay, because the budgeted fixed overhead over here would be calculated by taking the fixed overhead allocation rate and multiplying by budgeted production. So if the volume variance is favorable, it means that actual production must be greater than budgeted production, which means that the absorbed fixed overhead must be greater than the budgeted fixed overhead. So we can then calculate the absorbed fixed overhead as follows. The budgeted fixed overhead is 24 million. The variance is 12 million. So that's going to give us an absorbed fixed overhead of 36 million. The absorbed fixed overhead must be greater than the budgeted fixed overhead because actual production was greater than budgeted production. And you can see the difference between these two amounts over here, the difference between the budgeted fixed overhead and the absorbed fixed overhead is 12 million rand. And it's favorable because actual production is greater than budgeted production. So now we know what the absorbed fixed overhead is. If we are able to calculate this fixed overhead allocation rate over here, we'll have the absorbed fixed overhead, we'll have the fixed overhead allocation rate, and we can then work backwards to calculate actual production, which is the whole purpose behind what we are trying to do over here. So, are we able to calculate the fixed overhead allocation rate? It's the budgeted fixed overhead and we divide by normal capacity. That's in terms of IAS 2. We must allocate fixed overheads to inventory based on normal capacity. So we divide by normal capacity. Why do we use the budgeted fixed overhead instead of the actual fixed overhead? Remember, guys, we perform this calculation at the beginning of the year so that we can cost our inventory. And at the beginning of the year, we don't know the actual fixed overhead. We only have the budgeted fixed overhead. So the allocation rate is always calculated using the budgeted fixed overhead. So the budgeted fixed overhead is 24 million rand. And if we go back to the information provided in the scenario, you were not given normal capacity. However, please remember, where normal capacity is not given, you can use the budgeted capacity. So we know that the biscuit division budgeted to produce 200,000 units. So that's what we are going to use in our calculation. So that gives us a fixed overhead allocation rate of 120 Rand per unit. Now we have all of the information necessary to work backwards and calculate actual production. Remember, we calculate the absorbed fixed overhead by taking the fixed overhead allocation rate and multiplying by actual production. So if we want to make actual production the subject of the formula, so that we can solve for actual production, we are going to take the absorbed fixed overhead and divide by the fixed overhead allocation rate. So we calculated that the absorbed fixed overhead is 36 million rand. And we also calculated that the fixed overhead allocation rate is 120 Rand per unit. So that's going to give us actual production of 300,000 units. And just to make sure that you're happy with the understanding of everything over here, we can take this one step further. Remember, the volume variance, fixed overhead volume variance to be more specific, is the difference between what they actually produce and what they budget to produce. So if they actually produced 300,000 units and they budgeted to produce 200,000 units, the volume variance is as a result of them producing 100,000 units more than what they budgeted to produce. And that's why it's favorable. They actually produced more than what they budgeted to produce. That's why we have a favorable variance. And if we want the Rand value of the variance, because over here we've calculated the variance in units and not the Rand value, if we want the Rand value, we just need to multiply that by the fixed overhead allocation rate, which is 120 Rand per unit. And that is obviously going to give us a volume variance of 12 million Rand. Now, obviously, guys, you need to make sure that you present your solution in a way that's easy for a market to follow and to understand. Now, you can see what I've done over here is not easy to follow and understand because I was not preparing a perfect suggested solution. I was actually explaining to you the logic behind the calculation and why we're performing the calculation in that way. Please refer to my suggested solution and have a look at how the calculations are performed. Your calculation should look more like that, not with all of these arrows and everything that I've got going on over here. This is for your understanding so that after watching the video you can understand the logic behind the calculation, but please rather present your answer in the same way as I have in the suggested solution. All right, and now that we have actual production, we can wrap up the variance calculations. We need to multiply this by actual production because we are going to take the standard quantity for 1 unit and flex that to actual production. All right, right, so if we look at cookie dough, we are going to get a variance here of 2.7 million rand. So let's analyze this in more detail. According to the standard, in order to make 1 unit, they should have used 1.5 kilograms of cookie dough. So if they actually produced 300,000 units, they should have used 450,000 kilograms. You can see they actually used more than what they should have, so this variance is going to be unfavorable. And for chocolate chips, according to the standard, for each unit that is produced, they should input 1 kilogram of chocolate chips. So if they actually produced 300,000 units, they should input 300,000 kilograms of chocolate chips. They actually input 312,000 kilograms. So they actually used more than what they should have, and this variance is then also going to be unfavorable. Once again, if you have time, just calculate the variance in total. And please don't forget to reference to your calculations. All right, guys, so that then answers part B of the required. However, I just want to jump to one part of the suggested solution so that I can explain to you how losses in the production process work. So you'll see in the suggested solution, I have all of the calculations, and then just over here, make sure that you understand the logic behind losses in the production process. So I just want to quickly have a look at this with you now. Please note this does not form part of the suggested solution. You mustn't include this in your suggested solution. This is included just for your understanding. All right, so you'll remember we saw when we read through the information provided in the scenario that we have a normal loss in the production process. 20% of the material that's input is expected to be lost. So we know that in order to make 1 unit, they are going to input they should, according to the standard, they should input 1.5 kilograms of cookie dough and 1 kilogram of chocolate chips. So that gives us a total of 2.5 kilograms that they are inputting into the production process in order to make 1 unit. There's then a 20% normal loss, which means if they input 2.5 kilograms into the production process, they will only get 2 kilograms out the other side. And 1 unit is equal to 2 kilograms. So we can see that works perfectly. Now, we calculated that actual output is 300,000 units. So if they actually produced 300,000 units, the actual output would be 600,000 kilograms, because we know that 1 unit is equal to 2 kilograms. So working backwards, if output is 600,000 kilograms, how many kilograms would they need to input? Obviously, they can't input 600,000 kilograms because there's a 20% loss in the production process. So if they only input 600,000 kilograms, the output will not be 600,000 kilograms. So working backwards, 600,000 kilograms multiplied by 100 over 80. Remember, guys, the logic over here is always you multiply by what you want and you divide by what you've got. They put 100% of material into the production process. There's a 20% loss in the production process, so they only get 80% of the material out the other side. So if I'm trying to calculate the number of kilograms that need to be input into the production process, I'm trying to calculate 100%. So I multiply by what I want. I want 100%. I'm trying to calculate the number of kilograms that must be input into the production process. And I divide by what I've got. What have I got? The 600,000 kilograms over here is the output, which is 80%. That's what I've got. So I divide by 80%. So that's just the maths logic over there behind that calculation. So that gives us 750,000 kilograms. And you can see I've included a proof for you over here so that you can see everything works perfectly. If they input 750,000 kilograms into the production process and 20% is lost, that will give them output of 600,000 kilograms. So we can see everything ties in perfectly. That ties into the output over there. Okay, so all this tells us is if they actually made 300,000 units, they should have put 750,000 kilograms of raw material into the production process. That would have allowed them to make 300,000 units. However, they didn't actually input 750,000 kilograms into the production process. What did they actually input? For cookie dough, they actually input 405,600 kilograms, and for chocolate chips, they actually input 374,700 kilograms. So if we add those together, they actually input 780,000 kilograms into the production process. And you'll see, or you'll remember, that does tie into our previous calculations over here where we were putting that actual quantity into the standard mix. The actual quantity used was 780,000 kilograms. So to make 300,000 units, they should have input 750,000 kilograms. That takes the normal loss into account. However, they actually input 780,000 kilograms. So the difference between what they actually input and what they should have input gives us an abnormal loss of 30,000 kilograms. And you can see just below I've included a reconciliation for you. They actually input 780,000 kilograms. 30,000 kilograms was an abnormal loss, leaving them with 750,000 kilograms. Then we had a normal loss of 20%, so that's a normal loss of 150,000 kilograms, leaving them with output of 600,000 kilograms. We know that 1 unit is 2 kilograms, so with 600,000 kilograms, they were able to produce 300,000 units. All right, so why is it so important for you to understand this? Remember, guys, when we read through the information provided in the scenario, I said to you that in terms of IAS 2, normal losses are included in the value of inventory, and abnormal losses are not included in the value of inventory. They are expensed in the period incurred. So, because normal losses are included in the value of inventory, the standards over here take the normal losses into account. You can see, according to the standard, they have to input more than what they want in order to achieve a certain output. If they want output of 2 kilograms, they can't input 2 kilograms. They have to input 2.5 kilograms, and they'll then have output of 2 kilograms. So the standard over here takes the normal losses into account because normal losses are included in the value of inventory. However, the standard does not take abnormal losses into account. So when we are calculating the material usage variance, we won't have a variance for normal losses because the standard takes normal losses into account, which means the usage variance that we calculate is an abnormal loss. And I'm going to prove that to you. Okay. So what I want you to do first is calculate the material usage variance. And remember, the usage variance is the sum of the mix and the yield variance. So we calculated the material mix variance and the material yield variance. If we add those together, we get the material usage variance. And what I'm telling you is, because the standards take normal losses into account, this variance that we've calculated over here is not a normal loss. This variance that we've calculated over here is an abnormal loss. So what I'm saying to you is this unfavorable usage variance over here is because they actually used 30,000 kilograms more than what they should have used. They actually had an abnormal loss of 30,000 kilograms. So I want to prove to you that this usage variance, the rand value of this usage variance over here, is because they have an abnormal loss of 30,000 kilograms. So you'll remember we said above that the abnormal loss is the difference between what they actually input into the production process and what they should have input into the production process. So we are performing exactly the same calculation over here, but now we are just splitting the quantity between cookie dough and chocolate chips. So for cookie dough, they actually used 405,600 kilograms, and for chocolate chips, they actually used 374,400 kilograms. So the total over there comes back to the same 780,000 kilograms. Okay, we are just splitting this between the two products. So we said over here that they actually input 780,000 kilograms. We are now just looking at the split between the two products. So if we are trying to calculate the abnormal loss, it's the difference between what they actually input and what they should have input. So this column over here is dealing with what they should have input. Now in total, we know that they should have input 750,000 kilograms. So you'll see the total here comes back to 750,000 kilograms. But we need the split between the two products. So where do we get that split from? Guys, the quantity that they should have input is the standard quantity flexed to actual production. So we have already performed this calculation. If you go back to your variance calculations, here's the standard quantity flexed to actual production. So for cookie dough, it's 450,000 kilograms, and for chocolate chips, it is 300,000 kilograms. Giving us a total of 750,000 kilograms. So if we look at cookie dough, we can see they should have input 450,000 kilograms. They actually input 405,600 kilograms. So they actually input less than what they should have, which means this variance is going to be favorable. And the difference between the two is 44,400 kilograms. Then for the chocolate chips, they should have input 300,000 kilograms. They actually input 374,400 kilograms. So because they actually input more than what they should have, this variance is going to be unfavorable. And the difference between the two is 74,400 kilograms. So we've calculated the usage variance in kilograms. Because the one variance is favorable and the other variance is unfavorable, the net effect is we have an unfavorable variance of 30,000 kilograms. And that is your abnormal loss. Go back to the calculation above. The abnormal loss is 30,000 kilograms. So your usage variance is the abnormal loss, not the normal loss. The standard takes normal losses into account. So the usage variance is your abnormal loss. So if we want the usage variance then in rands, you just need to take the usage variance in kilograms and multiply by the standard price per kilogram. So the standard price per kilogram for cookie dough is 150 Rand, and for chocolate chips it is 200 Rand. You'll then calculate your variances over here, or the Rand value of your variances, and the net effect is you have a variance of 8,220,000 Rand unfavorable. And that ties into the usage variance just below, based on the variances that we calculated previously. So you can see here, guys, everything reconciles, everything ties in all nicely and perfectly, and you can see the mix and the yield variances that we calculated. Those variances do not represent normal losses. Normal losses are taken into account in the standard. So any mix or yield variance, in other words, your usage variance, is an abnormal loss.